In this final video on risk and return, let's conclude our discussion of the capital asset pricing model. Again, just to kind of reflect, it's an equilibrium model that talks about the relationship between risk and return in well-diversified portfolios. It's based on a premise that there is only one factor that affects risk. So what is that factor? That factor is market risk. And again, market risk, as we've talked about in previous videos, is measured by the statistic called beta, right? So we want to talk about how CAPM works. Here are a few more assumptions of capital asset pricing model. All assets are perfectly and easily divisible. There's no taxes, no transactions. Investors are price takers. That is, when people are buying and selling stocks, an individual, right, an individual investor cannot influence the stock price with their particular trades. To influence the stock price, we need an entire investing segment, right? Thousands and thousands of investors. That's how prices ultimately are changed. And finally, the quantities of all assets are given and fixed. So there's no growth in supply outside of what we already have. So the security market line, as we've been talking about, ultimately is derived from the capital market line. The capital market line talks about the risk-return relationship of efficient portfolios. The risk that we're talking about here is standard deviation. But the security market line looks at individual stocks or projects, and that risk is measured by beta. So they both measure risk and return, one specifically for only efficient portfolios, measuring risk by standard deviation, right, total risk, and then the other looking at individual stocks, but utilizing risk as measured by beta. So if we think about regression, right, we then have to think about, well, what is the range, if you will? What is the range of beta, right? So there's a 95% confidence interval in this regression output that's going to measure where beta should be. And obviously somewhere in that range is where beta shows up. So the typical range for an individual stock is a beta somewhere between 0.5 and 1.5. And for well-diversified portfolios, should be between 0.92 and 1.08. So again, you see everything is based around that 1.0 measure, which is what we refer to as the beta of the stock market. But the range here is really kind of narrow, right? There's individual stocks, for the most part, 95% of them are in this particular range. So what is the relationship then between standalone risk, market risk, and diversifiable risk? Well, standalone risk is market risk plus diversifiable risk. That's this formula up here, right? Here is the market risk of the stock, and here is the diversifiable risk for the stock, right? So again, always remember that standalone risk can be divided into two parts. Variance measures it. The stock market risk, the market risk of the stock, is beta squared times the variance of the stock market. And then the variance of the errors was what refers to as the diversifiable risk. So market risk, we know what that is. Diversifiable risk is what we refer to as company-specific risk. So what can we think about as far as tests, right? So the security market line should be a straight line. There should be a linear relationship. What we find is that we cannot deny that the relationship between risk and return is straight. So it is a straight line relationship. What we have issues with, though, is what is the slope? The slope is usually a little less than what we predict. Irrelevant of diversifiable risk specified in the CAPM model, that irrelevance can be questioned, right? So is diversifiable risk important or not important? And that's a piece that can be questioned, if you will. So how do we deal with these issues, right? Straight line makes sense for us, so we're good. The betas of individual securities are not really good estimators of future risk because of the very nature of them being individual. Betas of portfolios of 10 or more stocks are reasonably stable. So what this means is that the more stocks you have in a portfolio, the more stable your prediction of risk is going to be. The past portfolio betas are good estimators of future volatility. So again, the issue with capital market line is it is there for portfolios. So individual securities have issues. Why do they have issues? Because it's not just market risk. It's total risk with an individual security. So the relationship is a little bit iffy when we think about individuals versus portfolios. So again, are there problems with CAPM? Absolutely yes. A researcher, Richard Roll, basically says that because of the very nature of the market portfolio, it's virtually impossible to use a formula to adequately measure this relationship with risk and return as it is. He actually created another theory that's called the Arbitrage Pricing Theory. The capital asset pricing model is a single factor model. It says market risk is the only thing that affects returns. APT says it's more complex. There could be other factors, things like GDP growth, expected inflation, tax rates, dividends, right? There are lots of variables that may have an impact on return that is more than just the one single factor. So we end up with a formula. If we think about this part of the formula, that is the capital asset pricing model. Beta here, that beta sub I or beta I sub 1, right? That, let's just say that is the market beta from before. But this beta is the relationship with GDP. This relationship is the relationship with inflation. So the sensitivity of returns is dependent on the variables that we use. So we can use multiple regression to maybe calculate returns, and that may give us a more powerful, a more stable prediction of future returns. Fama and French were two researchers, and basically they identified some factors that did a pretty good job at predicting returns. So here is our beta for the stock market, but now here is a beta based on small firms minus big firms. Now I'm not sure how this variable worked, but it looks at firm size as a potential factor in explaining returns. We also have the book to market ratio that we use, and this book to market ratio, again, the lower this number, excuse me, the more likely it's an investment you might want to buy, right? So again, how this works, these factors could be utilized, gather the data and plug them in to the formula, and you would get a relationship. So are these firm characteristics correlated with actual risk factors? That's the big question. So what some researchers have said is that really these things are just additional measures of risk. They measure the same thing. So you really don't get more information. You just get more factors relating directly to the market risk of the company. But it's a very strong factor. So what about this arbitrage pricing theory, right? It is used for some real-world applications, but it's very difficult because the actual theory, the actual model, doesn't tell you what the factors are, right? Fama and French looked at variables. They did some research and they found out that these three variables seem to be related the most to returns. And they're related to each other in the least way. So the correlation between risk and return, between the factor and return, is strong, but the correlations between those factors is relatively low. So they're giving, since their relationships are low, they provide additional information. So APT is just it's theoretically, it's a very sound, very good, easy to use model, but in practice, it's not. It's very difficult to use because it gives us very little guidance on what variables to actually use. So that's the end of our risk return set of videos. So where do we go from here? The next steps we go is to measure the risk and returns of specific assets, stocks, bonds, financial securities, or financial options. We're also then going to look at projects in a corporation. How does the risk-return relationship fit into that type of analysis? So that's where we're going. Look forward to seeing you in the next video.